Stock split illusion, the game nobody's playing. Your favorite stock just announced a 2-for-1 split. The price is climbing, the crowd is celebrating. Here's what nobody's saying out loud: nothing just changed. Not the company, not its earnings, not its growth rate. Absolutely nothing about the actual business just got better or worse. But the stock is moving anyway. And if you're one of the millions of people who think a split is a bullish signal, that you're missing out. You're about to watch the math of this market work against you in a way that will only make sense once you see it. By the end of this video, you'll know exactly why companies split their stocks, who actually profits from that split, and what's happening in the market on split day that the headlines are carefully not mentioning. The illusion starts here. A stock split is mathematically simple. A company says, we're going to divide every share into more shares. 2-for-1 means one share becomes 2. The price adjusts down proportionally. One $400 share becomes two $200 shares. You own twice as many shares now. The total value stays the same. Mathematically, nothing happened. You had the same percentage of the company yesterday that you have today. Your profit or loss on that position didn't change. The earnings per share metric, how much profit the company makes for each share, gets adjusted too. It has to, otherwise the math lies. Everything adjusts proportionally. The company is still worth the same, you still own the same slice of it, and yet, the stock climbs on split announcement day. Why would the market pay more for something that is mathematically identical to what it was before? The answer is the entire game. The psychology trap. Here's what actually happens in human brains. A stock trading at $400 feels expensive. Your brain says, I can't afford that. Same stock split into $200 shares feels attainable. Your brain says, this is in my price range now. It's not. The price per share is meaningless. What matters is how much money you're giving up to own a piece of the company. A $400 stock or two $200 stocks cost the same to buy the same percentage. But that part of your brain that thinks in prices instead of percentages is screaming at you to buy because the number looks smaller. This is called the illusion of affordability. And it's not accidental. Companies know this. The boards that approve splits aren't stupid. They understand perfectly that a lower share price will attract retail buying pressure that has nothing to do with the fundamental value of the company. They approve the split anyway. Why would they do that if they don't profit from it? That's where this gets interesting. The real game, index inclusion. Wall Street has a rule, and this rule is where the actual money moves. Most index funds, the funds sitting in most people's retirement accounts, have minimum stock price requirements. The S&P 500, the Nasdaq 100, these indices have rules about which stocks can be included. One of those rules, historically, was that the stock price had to be above a certain threshold. Usually $5, $10 or more. That rule exists to keep penny stocks out of respectable indices, but here's the trap nobody talks about. When a company's stock price drops below the minimum, it gets removed from the index. When a stock gets removed, all the passive funds tracking that index are forced to sell it. Hundreds of billions in automatic selling. The stock craters. When a company splits and its price per share drops toward those minimums, what do you think they're trying to avoid? They're staying in the index. They're staying in the pool of stocks that every retirement account in America is automatically buying. Staying in that pool means staying in the flow of passive money. Leaving it means automatic fund liquidation. A stock split is index life support, but that's just the surface. The Nasdaq float multiplier, there's another rule, newer. Designed specifically to make companies easier to add to major indices. For companies with a small free float, that's the percentage of shares available to trade publicly, the Nasdaq applies a multiplier. They count the float as if it were 3 times bigger than it actually is. Why? So newly public companies, especially expensive ones with most shares locked in insider hands, can get added to indices faster. This forces index funds to buy them. More forced buying means the price goes up. Now here's where it connects to the split. When a company splits, what happens to the free float calculation? It stays the same percentage. But the index funds see more tradable shares in the market. the multiplier rule gets more aggressive, the forced buying intensifies. A split doesn't change the company. It doesn't change the fundamentals, it changes how the stock gets weighted in the indices. And it floods the stock with automatic buying from funds that have to own it whether they think it's a good price or not. That's the real mechanism. That's why insiders smile when a split is approved. Here's where the secondary offering comes in. Let me show you the setup most people miss completely. A company announces a split. The stock climbs for the reason we just talked about, psychological comfort plus index inclusion math. The price pops, the momentum builds, everyone's excited, the crowd is in. Then, perfectly timed for maximum enthusiasm and maximum stock price elevation, the company announces a secondary offering. A secondary offering is when an existing shareholder, usually a founder or early investor or the company itself, sells shares that are already outstanding, not new shares. Existing shares from locked-up insiders finally getting their chance to sell into retail demand. The price is high because of the split hype. The float just got bigger because the index rules got triggered. The buyers are already there because they had to buy for their retirement accounts. And insiders get to sell a massive block of shares at a price inflated by mechanics that had nothing to do with the company's actual business improving. The split is the setup. The offering is the payoff, and the people absorbing the supply at inflated prices are retail investors who thought they were getting a deal because the share price felt affordable. Watch this actually happen. Let's walk through a real example. Company XYZ trades at $800 per share. Insider holdings are mostly locked up. The company is profitable but expensive, maybe 50 times earnings. The stock is in all the major indices because the fundamentals are solid, even if the valuation is stretched. Then the founder decides it's time to cash out. The board approves a 4-for-1 split. The share price drops to $200. The market celebrates. Analysts write bullish notes. News coverage talks about the stock becoming more accessible. The fund managers seeing more shares available in the float and a lower nominal price. See the stock as newly qualified for more aggressive index weighting. Index funds start buying, FOMO builds, retail piles in. The stock climbs 20% in the first month. The price is now $240. The insider lockup expires. The founder sells 500,000 shares at $240 each. That's $120 million in proceeds. Before the split, selling 500,000 shares at the equivalent pre-split price would have been completely obvious and visible. The market would have immediately recognized this as insider selling into a stretched valuation. The stock would have tanked. But after the split, 500,000 shares doesn't feel like much. The float is bigger, the selling gets absorbed into the noise of trading activity. The crowd doesn't notice there being the demand absorbing insider supply. The founder cashes out. The stock drifts sideways for a few quarters. The retail buyers who felt smart buying at $200 watch their $240 investment fall back to $220. They tell themselves it's a temporary pullback. They're wrong. The easy money has already changed hands. That's how the mechanism works. The real winners and losers. Let's be clear about who wins and who loses in this arrangement. The insiders win. They get to sell locked-up shares at elevated prices created by psychological comfort and forced index buying. They wanted to cash out. The split gave them the perfect cover. The index funds win. They're required to own the stock anyway. The split just means they own more shares at a lower nominal price. Their returns are what they are. They don't care. They're not trying to time anything. The company wins. A split can improve the psychological relationship with the stock price. It can improve trading volume. It can keep the stock eligible for index inclusion. Those are material benefits to a company's public profile and trading metrics. Who loses? The retail buyer who sees the split, sees the pop, interprets it as a buy signal and buys at the inflated price. That's you if you're following the hype. The momentum that looked like validation was actually index mechanics and insider selling setup. The pattern works over and over. This isn't a one-time pattern. This is a game that plays out the same way repeatedly. Look back at any major split announcement in the past 5 years. Run the same analysis. Check the timeline of secondary offerings. Check the insider selling that follows. Check how many of those stocks are flat or underwater 6 months later. The pattern is clean. Split announcement, right arrow price pop, right arrow float expansion, right arrow index buying surge, right arrow secondary offering window opens, right arrow insiders sell into retail demand, right arrow stock normalizes. It's not hidden. It's not illegal. It's just a mechanical setup that benefits the people in the middle more than the people arriving late. And it keeps working because the retail interpretation of a stock split has never changed. A stock split still feels like a positive signal. It still triggers psychological comfort. It still reads as a growth catalyst. None of that is based on anything real about the company. It's based on share price psychology and index inclusion mechanics. What to actually watch if a company announces a split. Here's what you should be doing instead of buying. 1. Look at the insider lockup schedule. Check the prospectus. When do insiders actually become eligible to sell? A split that happens 3 months before a major lockup expiration is the setup for the exact game we just walked through. 2. Calculate the new float percentage before and after the split. If the free float jumps, the index inclusion math just got more aggressive. That's forced buying arriving, not smart money arriving. 3. Check the historical valuation. Where does this stock trade relative to earnings, revenue, growth rate? A split doesn't change that. If the valuation was stretched before, it's stretched after. The lower share price is just better marketing. 4. Mark your calendar for earnings reports. The first earnings print after a split usually shows whether the narrative of growth is real or just momentum. If the company beat the numbers and guidance is raised, the stock might deserve the higher price. If the company meets expectations and guidance is flat, the pop was just mechanics. 5. Wait for the secondary offering announcement. When it comes, and it usually does within 3 months of a split for a company whose insiders were locked up, you'll see the actual game. You'll see exactly how many shares are being sold. You'll see who's selling. You'll understand that the enthusiasm from the split was the setup for the supply that's about to arrive. The larger framework, this works because the market has moved to a place where mechanical rules create predictable buying and selling pressure that has nothing to do with company quality. Index inclusion rules create forced buying. Lockup schedules create predictable selling windows. Share price psychology creates retail demand. A company can engineer a sequence that takes advantage of all three, and none of it involves improving the business. The stock split is just the headline that triggers the cascade. Understand that cascade and you see past the hype. You see the mechanical setup. You see who's on the other side of the trade. And you make decisions based on that, not based on a lower share price feeling more accessible. Here's what changes everything the moment you stop interpreting a stock split as a bullish signal and start interpreting it as a mechanical setup. Everything changes about how you read the market. A split announcement no longer feels like confirmation you're missing out. It feels like a calendar event where certain things are going to happen on predictable dates. And when you know those dates and those mechanisms, you can watch them unfold without being surprised by them. You can also ask a simple question before you buy. Am I buying a company that's improving, or am I buying at the tail end of a mechanical setup designed to let insiders escape at elevated prices? That question saves money. The market will run its mechanics whether you understand them or not. Understanding them just means you're not the demand absorbing the supply. You're not the buyer arriving last at the popped price thinking you got a deal. You're the person watching the calendar, seeing the lockup expiration approaching, understanding that the split was the setup, and staying patient while the mechanics play out. And then, when the dust settles and the stock has normalized, if the fundamentals are actually good, it's still there to buy at a price set by reality instead of by a countdown clock. That's the framework. Watch it work on any split you see.